Finance is not only just about preparing and planning, but it's also about monitoring them and adjusting. You know, you need to be able to adjust quickly, you know, rather than letting an issue, I suppose, fester, Andrew, and not pick it up for 6 or 12 months, is being able to pick it up quickly, make an adjustment, and then, you know, making sure your business is still viable, you know, in the ongoing future. So when we're talking about monitoring finances, what are the best ways to do it?
Well, obviously, the most important thing is to do it regularly. Don't wait until the end of the year before you start to work out where your financial position is. Regular monitoring, regular advice, speaking to people. And this is why we bring in the subject of ratios, which will help you to identify how your business sits in comparison to other businesses of similar size.
Yeah, or it could be an industry standard. You know. Now, when we talk about ratios, there are a couple of different I suppose topics that you could have the ratio sit in. Obviously, there are things like liquidity, profitability, all those sorts of things. How do we work out what ours is, and also how do we benchmark them against the industry?
Okay, so what we're going to do with our ratios is identify which ratios are important to us, such as the profitability or leverage, which is our ability to get cash to make additional purchases, or our liquidity or activity. Monitor our KPIs, see how our numbers are going in relation to what our targets or our goals are. So all these numbers need to be identified. A lot of this information is going to be coming from our profit and loss, our statement of net worth, or other indicators that you're going to keep in your record system.
So what if we had a look and looked at some practical examples? What do you think?
Let's have a look.
So Andrew, there's a number of different ratios we can look at here, and I hear a lot of business owners say, well, I let my accountant handle that and they deal with it. And it's true, they do look at a lot of and oversee a lot of these things, but as a business owner, it's really important, not necessarily that we have to calculate them every day or every month, but we at least understand where they're coming from, obviously, and then what it means. So how can we react to it? So if we looked at, let's say, liquidity is one that's often used.
Yes.
And what's the ratio there?
So what we're going to be looking at is our cash, our accounts receivable, the available overdraft, short-term investments, and we're going to divide that by our liabilities, and that'll give us a percentage which will show us what sort of rates we've got left to be able to fund other investments.
Exactly right. So we're looking at total current assets over total current liability. So what we're looking at is the ability to be able to pay short-term debts. So in cash, in current assets, we have commission receivable, which is what we've got in our account now. We might have cash at bank, things that we can pay.
Petty cash.
So, petty cash, those sorts of things, although depending how much petty cash you have in a company, it might not necessarily cover your overdraft. But in your current liabilities, you're going to have short-term debts. So your overdraft, for example, in 20,000. So if we looked at this example over here, we are simply going to work out the calculation in very simple terms, being 67,500 over 20,000. So what we are saying is our ability at this point in time to be able to pay our short-term debt is very, very strong. Okay, does that make sense?
Yeah.
Great. What are some other ratios that we might look on a regular basis?
Again, you're going to look at your leverage ratios. We're going to look at our debt to asset ratios.
Leverage?
Leverage, which is our debt divided by total assets.
So if we looked at debt over total assets here, obviously where are we going to get our debt from?
Our liabilities.
So total liabilities here, so 70,000 over your total assets, which are going to come from obviously here. So we need to work some calculations out. So 437,500. So here again, this company, looking at this very simple form, is in a very strong position when we look at our debt to asset, because our total assets is far greater than our total debt. If it was reversed, we would know we would have to put something in place in order to make amends to that in some way, shape or form. Whether that may be servicing a bit more of the debt to bring their debt down, or vice versa, whatever it may be. You might have to do something, but what you would be able to do is work it out over time, where it started, and then as you constantly monitor this, you'll be able to work out what's changing.
That's right, and this is the same as this is helping us to identify the strength and the stability of the company financially. Our KPIs help us to monitor performance and where improvements can be made through individual behaviours and what they're doing within the office.
And if you've worked in a real estate office, you would know what a KPI or an example of how you would be able, what you would have to do in order to get to the certain level. Obviously in sales, it's very often how many calls you make, how many connections you make, how many listings you get, and then how many sales you can get to. It's very similar. And obviously in property management, you've got similar things.
That's right. And this is more a financial analysis of how the company's tracking.
Exactly right. Right, so hopefully that helps everyone outside. But when you're looking at ratios, you need to obviously understand what's going on in terms of the numbers, understanding what might be happening as it changes over time, but more importantly, understanding what you can do to rectify it if there's any issues, and you can pick up on it quicker rather than picking up on it on a yearly basis. I think that's the idea.